The Roth 401k and Roth IRA both work the same way in the sense that you're contributing money that you already paid taxes on. That money grows tax-free, and when you take it out, currently you don't pay any tax on withdrawals of that money. So that's a major benefit, having the ability to pay tax now, tax-deferred growth, and that tax-free income in the future.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. If you're someone who got a late start on saving for retirement and you're trying to save as much money as possible in a tax-advantaged way, then this episode is for you. This week, I'm going to talk about Mega Backdoor Roth IRA, what it is, how it works, who should consider it, and what the alternatives are if you don't qualify. So first, what is it? And before outlining the Mega Backdoor Roth, you really need to understand how the traditional Roth account works and also the Backdoor Roth conversion. So I'll give a brief refresher on those. And if you want to learn more about those, you can always go back and listen to episode 67 or episode 25 where I talk more about that. But the Roth 401k and Roth IRA both work the same way in the sense that you're contributing money that you already paid taxes on. That money grows tax-free, and when you take it out, currently you don't pay any tax on withdrawals of that money. So that's a major benefit, having the ability to pay tax now, tax-deferred growth, and that tax-free income in the future. The Roth 401k is dependent upon if your company has that option. Many large companies do. There's no income limitation, so that's pretty straightforward as far as being able to contribute to that. If you own your own business, you could also set up a small business 401k plan that did allow for Roth 401k contributions as well. To make the Roth IRA contribution, that's a little trickier because that is dependent upon your adjusted gross income and your tax filing status. If you are a single filer, then your adjusted gross income for 2022 has to be under $129,000 to make the full contribution. If you file married, filing jointly, then your adjusted gross income has to be under $204,000 to make that full contribution. There's also a third option, and that is converting some of your traditional IRA or 401k money over to a Roth IRA. And on the conversion, you'd pay tax at your current rates, and then you'd have the benefit of having that over in a Roth IRA. And as I've mentioned in previous episodes, that conversion strategy is going to work best in years where you have little to no income so that you're paying tax on the conversion at the lowest rate possible. So if you're listening to this because you're planning for your retirement, you're getting close to retiring, and as I mentioned at the beginning of the episode, trying to accelerate your retirement savings, then that's probably not the strategy for you now. What you're looking at is trying to get money into the Roth accounts so that you can get the benefit of the tax-deferred growth. One way to do that is to be eligible for what's known as the Mega Backdoor Roth IRA. And typically with your 401k, you're probably aware of the limits where you're eligible to put away up to $27,000 this year if you're over 50. If you're under 50, then that number is $20,500. In the Roth IRA, as a reminder, the limit this year is $7,000, and if you're under 50, it's $6,000. But what if you're looking to put away even more than those amounts and have it benefit you by being tax deferred? Then you may be eligible to make the Mega Backdoor Roth account. And to know if you're eligible for this, your company has to allow, first of all, they have to allow after-tax contributions. And not every company allows after-tax contributions. And they also have to allow for what's known as an in-service withdrawal. Chances are if you work for a larger company, you've got a much better chance of this being the case. As I mentioned earlier, if you're self-employed, you can set up your own 401k plan so that you can have these features on your plan and to be able to take advantage of this. So there's a higher limit above and beyond the traditional 401k limit that you're familiar with, and that is the total profit sharing contribution limit. And that is also based on whether you're under 50 or over 50. So if you're under 50, that limit is $61,000. If you're 50 and older, that annual limit is $67,500. And that limit is the combined contributions between what you're making and your employer is making. Let's just say that you work for Pratt & Whitney, so a local company to where I am, and their parent company is Raytheon. And you're making $150,000 this year, and you're already on schedule to maximize your traditional 401k contribution on a pre-tax basis. So you're putting in $27,000, and the employer match is 3%. So they're putting in an additional $4,500, bringing your total combined contribution between the two of you to $31,500. And because you're over 50, then would subtract that from the total profit sharing contribution limit of $67,500, which will leave you $36,000. So that means you could contribute $36,000 on an after-tax basis to your Pratt & Whitney 401k. So right there, that's additional money that you could put away on a tax-deferred basis. And to make the most of this, what you'd want to do is you'd want to convert that money over to a Roth IRA as soon as you can. By doing that, you would then benefit from the tax-deferred growth that would occur on top of whatever the amount is that you're putting away on an after-tax basis. Now, that's a lot of money to be putting away after tax. Maybe you don't have the ability to do all of that. Maybe you put away $10,000 after tax. Whatever the amount is that you can put away on an after-tax basis, that's going to benefit you down the road because that money is eligible to move over into your Roth IRA. Now, to really make the most of this, as I mentioned before, you'd want to make sure that your plan also allowed in-service withdrawals or allows what's known as an in-plan conversion. What that means is that to really benefit from this, as I said, you want to get that money out of your 401k over to your Roth IRA because any growth that occurs on the after-tax money while it's in your traditional 401k is going over to the pre-tax side. So let's just say you did contribute this $36,000 and you left the money invested for a year and it gained $10,000. Well, that $10,000 gain is being repositioned over in your taxable 401k, your pre-tax account, and you would then pay tax on that money when it comes out. But if you were instead, shortly thereafter, maybe after the year was over, through an in-service distribution, roll over that $36,000 into your Roth IRA and that same $10,000 of growth occurred, well, that's now all tax-free to you because it's in your Roth IRA. Now, not all plans allow in-service distributions, and it isn't as beneficial to doing this because you aren't getting the benefit of the growth. You would only be able to convert your contributions over to your Roth IRA, but it still could be more beneficial than the alternative of just investing that money in a taxable account. Processing this in-service withdrawal is a lot more straightforward if you're under 59.5. Because of the rules with most 401k plans, you actually are only eligible to roll over your after-tax contributions, so that's pretty straightforward. But when you reach age 59.5, you actually have to be aware of what's known as the Prorata Rule, which means that if you're doing an in-service withdrawal, you wouldn't be able to just request the after-tax portion. You would receive some pre-tax money and after-tax. So let's just say you had a 401k balance with $100,000 and $80,000 of that as pre-tax, $20,000 was post-tax, and you requested an in-service withdrawal. They would most likely send you all of it, and that $80,000 of pre-tax money would be taxable to you. So you'd want to set up a traditional IRA and move that money over to the traditional IRA so that this in-service withdrawal wasn't taxable to you. The post-tax money would go over to the Roth IRA. Where that could mess you up is that if you're also pursuing the backdoor Roth, not the mega backdoor Roth, of putting that $7,000 in your traditional IRA and then converting it to a Roth, having IRA assets is going to make that strategy not effective. So you'd want to weigh that decision. And if your plan allows you to roll that money back into your 401k, you could also do that so that you could continue making that backdoor Roth $7,000 contribution. However, it could be far more beneficial in my prior example to be able to contribute $36,000 into your Roth account than $7,000. So you have to weigh those trade-offs that might occur. So who should consider doing this? Well, before you get too excited about doing this, going beyond the additional $7,000 Roth IRA contribution, you really want to understand if this is suited for you. So I would say it would be suited for you if you're already maximizing your traditional 401k contribution, you're not eligible for a Roth IRA contribution, and you have other IRA assets that are disqualifying you from that, you have already taken care of some of your other key financial goals, like having an emergency fund, paying down debt, maybe saving for college, and you're going to be okay cash flow wise if you put this extra money into the 401k plan on an after-tax basis. You have enough other money coming in. And another key thing that your company allows for these in-service withdrawals. So if you fall into that category, then this can be a great way to jumpstart what you're doing. I will say one thing, that part of what was in the legislation, Build Back Better plan, which didn't pass Congress, was to eliminate the ability to convert these after-tax monies over to the Roth IRA. So you still would be able to contribute on an after-tax basis, but you wouldn't be able to convert the money. So it could lose some of its bite. And as I mentioned before, you want to check with your employer. That's the easiest way. I know in my local area, some of the companies like Prudential, Lockheed & Martin, Raytheon, they do offer this option, but you want to call your 401k provider to find out if you can take advantage of this. Or by logging into your account, you might see right there in your 401k, it might have a section for after-tax contributions. And it could be even better if your plan allows for in-plan conversions. And what that means is that you don't have to go through the steps of processing in-service withdrawal, taking the money, moving it over to a Roth IRA. You're actually right inside the plan. They're able to move it over into your Roth 401k for you so that you don't have to jump through all these hoops. There are not a lot of companies that do offer this. More companies are starting to do this. So that's another thing that you could check on. What are some alternatives to this if you don't qualify because your company doesn't offer it? One is that you could use a taxable investment account. You could purchase mutual funds or exchange traded funds with low turnover and invest in those. You'd only be paying tax on the dividends and interest on an annual basis until you sold the investments. You also could consider the Backdoor Roth IRA conversion that I mentioned at the beginning of this episode. Or if you want to contribute to a Roth 401k, if your employer offers that, you could do that as well. The negative is that you aren't getting any tax deduction. So my number one strategy would be that if you're eligible to do this, you would contribute the maximum to your 401k on a pre-tax basis, therefore helping you get the maximum deduction that you can. And then you'd maximize your 401k profit sharing contribution by putting in as much after-tax contribution as you could and then converting that on an annual basis. But again, we have to keep aware of what happens with the Build Back Better plan, or if some version of that passes Congress and this is eliminated. But for now, it's still a go for this tax year unless they make a retroactive change. So I hope you found this episode beneficial on how you can really jumpstart your retirement savings. And if you're looking to increase your knowledge on retirement planning or put together your own plan for retirement, consider attending my retirement readiness workshop. I still have one that has the ability to sign up for it. You can sign up by going to retirewithryan.com. Have a great week, and I'll talk to you next Wednesday.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.